ChargePoint Holdings, ticker CHPT. If you were following the EV space a few years ago, you thought this was the future. The reliable backbone of the entire electric transition, the pioneering king of infrastructure. Now we look at the price, a distressed asset trading around $7.89 share, and you have to confront a serious question. Is this company priced for survival? Or is its recent high-interest debt restructuring merely a highly expensive pause before insolvency?
That is precisely the ultimate mission of this deep dive. The market has, it's just decimated ChargePoint, knocking the stock down over 95% from its high-flying SPAC peak.
95%.
It's incredible.
Yeah.
And the recent corporate maneuvers, and we need to be blunt about this, the painful 1-for-20 reverse stock split in July and the massive debt restructuring finalized in November, these are not indicators of growth. They are the desperate, high-stakes moves of a company fighting for its life during the EV winter.
And crucially, that desperate survival is being funded by new debt carrying a crippling 12% interest rate. That cost alone fundamentally alters their future viability.
Absolutely. We are dissecting ChargePoint post-crisis, examining its core assets, its management's emergency actions, and the extreme risks it now faces. We need to determine if the market's current valuation, which, for a little tease, we see anchored right in the survival range between $6.50 and $9, is reflective of a credible recovery path, or if that 12% debt has created a liquidity trap from which they simply cannot escape.
It truly is a binary outcome for this stock. Are they the phoenix or the cautionary tale? We are going to help you navigate those scenarios. We have 7 crucial stages of analysis today, starting with the complex business model that was built for hypergrowth, but is now being tested by, well, recessionary headwinds.
Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, business understanding.
Okay.
When people think of EV charging, they often default to the image of a Tesla supercharger or an EV go station where you pull up, plug in, and pay. ChargePoint is fundamentally different. What exactly is their B2B2C model, and why was that model supposed to be capital efficient but is now proving so fragile?
ChargePoint is the textbook definition of the picks and shovels analogy in the gold rush. They are an asset-light technology provider.
Right.
They don't own the mines, they sell the tools. Their business model is B2B2C, meaning they sell charging hardware and, more importantly, a sophisticated cloud software subscription to site hosts.
And those site hosts being businesses, apartment complexes, fleet operators, municipalities, that kind of thing.
Correct. The key difference is capital expenditure. The site host owns the physical asset, they buy the electricity from the utility, and they handle the maintenance and pricing structure, all managed through ChargePoint software. This is massively different from owner-operators like EVgo or Electrify America.
Who have to spend billions.
Exactly. They have to shoulder billions in capital expenditure for land acquisition, deployment, grid hookups, and continuous maintenance. ChargePoint was supposed to be high-margin software sales, piggybacking on industrial capital.
That distinction is crucial, because it defines their revenue streams and why their current revenue mix is a source of both pain and, I guess, some hope.
Well, their revenue is split into 2 main buckets, plus a crucial third minor one. Historically, the breadwinner was networked charging systems, which is the hardware, the physical bollards, and DC fast chargers.
The actual boxes.
The actual boxes. This was 60% to 75% of total revenue, but this is their current liability. Hardware is low margin and it's cyclical. In the most recent quarter, hardware revenue declined a staggering 21% year over year.
Wow. And the reason for that 21% contraction ties directly to the macro environment, doesn't it?
Absolutely. When the 10-year Treasury yield is sitting above 4% and borrowing costs are high, site hosts, those businesses and municipalities, they just pull back on non-essential capital expenditures.
Of course.
They delay fleet upgrades, they halt new parking lot installations. ChargePoint's hardware sales rely entirely on external capital budgets freezing up, and that's what we've seen during this EV winter.
Which makes the second revenue stream, subscriptions, the only real source of optimism. This is the promised high-margin, sticky recurring core of the business.
This is the bull thesis. It has to be. Subscriptions, the software and cloud services, now account for approximately 40% of their total revenue. This is the brain of the operation. It allows the site host to manage everything. Sophisticated energy load balancing, which is critical for grid stability. Integration with massive corporate fleet card services, customized pricing controls, and driver dashboard analytics.
I hear the word sticky used constantly. Why is the ChargePoint software so difficult for a site host to replace? Make that switching cost tangible for us.
Okay, think of a large regional fleet operator, a delivery service, for example. They might have 50 depot locations and thousands of drivers using the ChargePoint software for route optimization, detailed energy reporting for tax purposes, and integration with their payroll and logistics systems.
It's embedded deep in their operations.
Deep. To switch networks, they wouldn't just need to rip out the hardware, which is expensive enough. They would have to migrate thousands of driver accounts, rewrite APIs connecting the charging data to their central logistics platform, and retrain all their energy managers on a completely new load balancing system. The organizational disruption and retraining costs, they just dwarf any potential savings from buying slightly cheaper hardware elsewhere. That complexity is the software moat.
Okay, that makes the stickiness really clear.
Yeah.
Before we move on, you mentioned a crucial third minor revenue stream that often gets ignored but is pretty high margin in this sector.
Yeah.
Regulatory credits.
Right, that's the LCFS revenue, or low carbon fuel standard credits, particularly relevant in states like California.
Right.
When ChargePoint facilitates clean energy usage through its network, it can generate tradable regulatory credits. This is non-core revenue, but it is high margin and stable, adding a necessary layer of cash flow. It helps offset some of the hardware losses, but look, it's not enough to fix the fundamental cash burn issue.
Despite the financial struggles, ChargePoint still has significant scale in North America.
Oh, absolutely. They are the undisputed volume leader in commercial networked Level 2 charging, holding historically between 60% and 70% market share. This scale gives them a massive unique data advantage. They process millions of charging sessions data that provides proprietary insight into driver behavior, peak demand times, and critical grid load patterns that are essential for future energy management products.
But the downside, and this is a big one, is that this dominance doesn't carry over into DC fast charging, which is what retail consumers rely on most.
Correct. In Level 3 or DC fast charging, Tesla is the absolute benchmark for reliability, speed, and overall port count. Their vertical integration ensures that when a driver pulls up to a supercharger, it just works, almost flawlessly. This lack of L3 dominance for ChargePoint, coupled with the variability of site host maintenance, is what leads us directly into the current industry headwinds.
Let's elaborate on this EV winter. We've covered high interest rates, the 4.09% 10-year Treasury slowing CapEx. But the structural forces of commoditization and the NACS transition are also massive problems. The commoditization of basic AC hardware is relentless. I mean, low-cost Asian manufacturers, backed by state subsidies, are flooding the market with functional basic chargers.
Just a race to the bottom on price.
A total race to the bottom. This pushes ChargePoint and all legacy providers toward a painful choice. Either compete on price and accept razor-thin margins, or rapidly differentiate through software functionality. They have chosen the latter, but the former is still dragging down their entire hardware division. And the NACS transition, the entire industry moving to Tesla's North American charging standard, is an existential shift they're forced to fund during a crisis.
It is an unavoidable operational drag and a capital sink. By late 2025, virtually all major automakers are adopting Tesla's connector. ChargePoint has to rapidly retool its manufacturing lines, manage obsolete inventory, produce and distribute adapter kits, and ensure seamless software integration for every existing and future station. This capital burden disrupts their short-term sales cycles and strains R&D resources at a time when they are desperately conserving cash.
So ChargePoint is fighting what the source material correctly labels a three-front war. Let's dissect the competitors they faced on each of those fronts.
Okay, front one is the behemoth, Tesla. Now that the supercharger network is opening up to non-Tesla EVs, Tesla is direct competition. Their reliability and scale are just unmatched.
Yeah.
When a driver has a choice between a 99.9% reliable supercharger and a ChargePoint L2 charger whose uptime depends entirely on whether the local mall owner fixed it, the driver's choice is clear.
And that gets to the core vulnerability of ChargePoint's model, doesn't it? Brand perception is damaged by third-party failures.
Exactly. ChargePoint's brand reputation takes the hit for maintenance issues it doesn't control. Now, front two is the owner-operators like EVgo and Electrify America. While they're capital-intensive, they control their entire ecosystem, from site selection to maintenance. EVgo, in particular, has shown superior recent L3 deployment growth, which signals to the market that direct control over infrastructure is currently a preferred, if expensive, model.
Which is why EVgo gets a much higher valuation multiple.
Much higher. And front three, the massive industrial hardware giants like Eaton and ABB who have scale and deep pockets. This is where ChargePoint's recent strategy comes into play.
The Eaton partnership.
Yes, the partnership with Eaton is a masterstroke of defensive strategy. Eaton is an industrial powerhouse, By partnering with them for modular DC fast charging architecture, ChargePoint gets access to Eaton's superior supply chain, industrial design expertise, and manufacturing scale. This allows ChargePoint to outsource manufacturing complexity, lower its cost of goods sold, or COGS for hardware, improve reliability, and accelerate NACS integration, all without burning their own precious cash on tooling or factory expansion. It's an attempt to transform into a capital-light entity through partnership.
So the overall conclusion for the business model is that the physical product, the box itself, is easily replicable. The moat is entirely software and network data.
It has to be. I mean, anyone can produce a charger box.
Yeah.
But the barrier to entry for replicating the network, the billing clearinghouse, the integration with hundreds of fleet providers, the ability to manage complex utility load profiles, that barrier is still very high. That software sophistication is the single unique asset keeping ChargePoint relevant and protected from low-cost displacement.
Chapter 2. Management Evaluation.
Right. When evaluating a company in crisis, you are really evaluating the people managing the crisis. And this is a leadership team that was built for high-flying growth, and now they have completely pivoted to gritty, unsentimental survival.
And the face of that pivot is the CEO, Rick Wilmer, who took over in late 2023 specifically to impose operational discipline. He wasn't hired for vision, he was hired for the operational meat grinder.
Wilmer's tenure is defined by triage. He has imposed unsentimental defensive moves across the board. We've seen significant cost structure reduction, including multiple rounds of layoffs, reducing the workforce by over 15%. And crucially, he oversaw the corporate actions necessary to keep the company solvent and publicly traded.
Let's talk about that 1-for-20 reverse stock split. Management called it legally required to maintain NYSE compliance. But for the retail investors who saw their share count just decimated, wasn't that viewed more as a final betrayal after years of misguidance?
Oh, it was a brutal PR moment, and the optic damage was severe. While technically necessary to maintain the $1 minimum share price and avoid being delisted, it's a classic signal of distress and a huge morale killer.
Yeah.
But without Wilmer driving that decision, the company faced forced delisting, which would have been catastrophic. Likewise, he orchestrated the crucial November debt restructuring to push the maturity wall back from 2028 to 2030, buying essential time. He's a crisis manager, executing defensive plays, often unpopular ones.
But crisis management breeds instability, and the source material points directly to executive churn as a massive red flag.
The C-suite turmoil is glaring evidence of internal stress. The departure of CFO Rex Jackson, followed by the chief legal officer Rebecca Chavez, leaving in mid-2025. I mean, losing your top financial and legal officers during a period of complex debt restructuring and SEC compliance challenges. It signals serious internal disagreements or a complete lack of faith in the company's ability to execute the turnaround.
When the people closest to the books are heading for the exits.
Investors should absolutely view that as a severe negative indicator.
That instability is compounded by the fact that management's communication style had to shift from hypergrowth to sheer realism, which I imagine damaged their credibility.
Exactly. They abandoned the optimistic SPAC-era narratives about total addressable market and hockey stick growth. Now the focus is gritty, grounded talk about adjusted EBITDA and cash preservation. The realism is welcome, but that shift happened only after a frustrating pattern of missed guidance targets in 2023 and 2024. They repeatedly overpromised on profitability timelines, and that erosion of trust is expensive and very difficult to recover.
Let's look at insider actions, because this is where retail investors find the clearest signal. If management is not buying the stock at these depressed levels, why should I?
It's one of the most sobering elements of the data. Insider ownership is low, around 2%. The transaction logs are full of sell-to-cover activity, where executives sell shares automatically to cover the tax liabilities on vested stock. That's normal.
Right, that happens everywhere.
It does. However, the critical negative signal is the complete and utter absence of open market purchases.
So there is zero evidence of executives using their personal cash to buy shares at $7.89.
None. Zero. If management truly believed the current stock price represented a 95% discount from the peak and that the turnaround was imminent, they would be aggressively buying. Their lack of buying strongly suggests they do not believe the immediate upside outweighs the immense operational and financial risks currently facing the balance sheet. It is an implicit vote of no confidence to the rest of the market.
And that mindset is reflected entirely in their capital allocation strategy, which has moved entirely into a defensive preservation mode.
M&A is completely off the table. Historically, they used their inflated stock to buy companies like Viability to enter European markets and expand fleet capabilities. That burned cash, added complexity, and increased operating expenses. Today, every dollar is allocated to two things: critical R&D like NACS integration and debt service payments.
And the return on invested capital, the ROIC, shows the price of that historical spending.
It is deeply, deeply negative. The company raised billions in the last few years, and that capital has resulted in cumulative net losses exceeding $1.5 billion. The massive operating expenses required to sell and support the hardware have continuously overwhelmed the software profitability thesis. Add to this the history of dilution, compounded by the warrants issued during the debt exchange for 1.67 million shares, and shareholders have just been consistently punished.
Chapter 3. Financial health.
Okay.
We must now move beyond the business model and look at the actual numbers. The balance sheet reveals the stark reality of this distressed pricing.
The current market cap is roughly $184.2 million. Just digest that for a moment. This company was once valued as a multi-billion-dollar tech stock, and it's now trading at a fraction of that. The decline signals a complete re-rating of the asset from hypergrowth to a high-risk, distressed industrial vendor.
And the growth trajectory that was supposed to be unstoppable has completely stalled and reversed.
The revenue followed a textbook S-curve that just hit a brick wall. FY 2021 to FY 2023 saw hypergrowth, sometimes 80% to 100% annually. Then, in FY 2024, growth slowed to 8%, and in FY 2025, revenue contracted 18% to $417.1 million. Q2 of FY 2026 showed a continued contraction of 9% year over year.
Oof.
The core takeaway is this: ChargePoint cannot generate stable revenue growth when its customers cannot secure cheap capital for expansion.
If the turnaround is going to happen, it has to start with margin improvement, driven by that software pivot. Is there any evidence that the high-margin subscription business is actually helping?
Yes, there is a glimmer of hope on the gross margin line. App gross margin improved to 31% in Q2 FY 2026, up from 24% the prior year, with non-GAAP margins hitting 33%.
Okay, that's something.
It is something, and it's a direct result of two things: the increasing mix of higher margin subscription revenue, now 40%, and aggressive supply chain optimization and cost cuts on the hardware side. That said, the net margin reality check is painful.
How, Pete?
They are still deeply unprofitable. Net margin remains stubbornly negative, currently sitting around negative 65%. They are generating 33 cents of gross profit for every dollar of sales, but spending 98 cents on G&A and R&D. And the new debt service is only going to anchor that negative net margin further.
So they're in a race against time, needing to reach even to break even before they run out of cash. And free cash flow has never been positive.
Never. The company has been a serial cash incinerator, historically burning $50 to $70 million per quarter. While operational cuts have reduced the magnitude of the burn, FCF margin is still severely negative at approximately negative 20%. They must hit EBITDA break-in within the next 18 to 24 months. If they fail, their liquidity reserves become terminal.
Which brings us to the elephant in the room, the debt crisis and the November restructuring. This maneuver was brilliant on paper. It bought them time, but it introduced a killer cost.
This was the defining corporate moment. They had $329 million in convertible notes due in 2028. Convertible notes are unsecured debt. They swapped this high face value debt for a new, smaller $157 million senior secured term loan due in 2030, plus issued equity warrants.
Okay, they retired $329 million in debt for a new obligation of $157 million. That sounds like a miracle for the balance sheet, but you said they created a massive one-time gain. How does that accounting work?
Right, that gain is strictly an accounting maneuver. Because the old debt, the convertibles, had a higher face value than the new secured debt obligation they issued. The difference, about $172 million, is recognized as a gain on the income statement from deleveraging. It makes the GAAP books look better immediately, but it doesn't generate a single penny of operational cash flow. It's a technical victory designed to stabilize the balance sheet's appearance.
And the real cost of this lifeline?
The cost is extreme and operational. The new loan is a senior secured term loan, meaning those creditors are first in line, and that debt is backed by company assets. It carries an extraordinarily high 12% interest rate.
12%.
12%. They replaced a potential solvency threat in 2028 with a crippling cash flow drain starting right now. The 12% interest, payable either in cash or paid in kind, or PIK, which means adding it to the principal, significantly restricts their agility to fund R&D or expansion for the next 5 years.
Let's discuss the valuation, as the negative earnings make the PE ratio completely irrelevant. We have to rely on price to sales, PS, to understand how distressed the market thinks they are.
ChargePoint trades at roughly 0.47 times trailing 12-month sales. In a sector dominated by technology and infrastructure where most companies trade at multiples of 3x or 4x sales, this is a classic distressed pricing multiple. The market is screaming, this revenue stream is unreliable and we doubt its permanence.
And when you compare that 0.47x multiple to their peers, the pessimism becomes even more stark.
It highlights the extreme risk premium. EVgo, the owner-operator, trades at 2.5x to 3.0x sales because the market rewards control over the infrastructure. Blink trades at 1.37x sales. ChargePoint trades at less than 1/5 of EVgo's multiple. This vast disparity stems from the market's perceived fragility of the site host model during a macroeconomic downturn. The revenue stream is just too dependent on third-party CapEx decisions.
This inherent risk must absolutely punish the discounted cash flow or DCF model results. Let's talk about the specific inputs for that calculation.
Because of the high volatility and financial risk, we have to factor in a very punishing discount rate. Our weighted average cost of capital, or WACC, is set at a staggering 14.5%.
Wow.
To put that in perspective, a stable large-cap tech company might see a WACC around 7% or 8%. Our high rate is driven by two factors: a high volatility beta of 2.22, and critically, that 12% cost of debt.
And why is a 14.5% WACC so punishing in practical terms for the listener?
A higher discount rate means future cash flows are worth significantly less today. If ChargePoint manages to become profitable in 5 years, discounting those profits back at 14.5% versus 8% makes them seem almost negligible. It forces the management to deliver immediate, near-term profitability to justify the current price, reflecting the market's complete lack of patience or faith in distant promises.
And after all that analysis, the current stock price of $7.89 lands exactly where?
It lands squarely in the middle of our base case range, which models for successful stabilization and management of the debt. $6.50 to $9 per share. The market is pricing survival, period. Our bull case, which models for a full SaaS transformation, shows massive upside potential to $14 to $18, but that requires flawless execution and 2 years of macro improvement.
That is critical context to understand the risk-reward ratio here. Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
Right.
We now shift to how the external world, Wall Street, the media, and algorithmic traders views this high-risk turnaround play.
Are professional analysts finally starting to bang the drum for a recovery, given the huge discount from the peak?
Not with any real conviction. The consensus rating is a very lukewarm hold. No one wants to commit to a buy or a sell. The average price target is somewhat misleadingly high, sitting between $11.50 and $13.78, implying significant upside if execution succeeds.
But you mentioned the dispersion of those targets is a more honest indicator than the average itself.
Absolutely. The targets range from a bearish $8, essentially saying the stock is correctly valued for insolvency risk, to an optimistic $20, which assumes a pure SaaS transformation. That massive dispersion shows Wall Street is profoundly split. Analysts have models that show both scenarios, a complete liquidity failure and a successful pivot. They simply lack consensus conviction on which path management will actually follow.
And the media narrative certainly hasn't helped management build a consistent recovery story either.
No, the media coverage is overwhelmingly negative and focuses on the trauma. The dominant themes are cash crunch, dilution risk, and the continuous bad press surrounding the 1-for-20 reverse stock split.
That had to hurt.
That reverse split was widely covered as a distress signal, severely damaging retail investor morale and reinforcing the perception of a broken company. Positive news, like the Eaton partnership, tends to get drowned out by the noise of financial distress.
Given that negativity, what do the technical charts tell us about the short-term future?
The charts confirm the bearish trend. The stock is trading well below both the 50-day and the 200-day moving averages. The technical environment is hostile, confirmed by a death cross that occurred months ago and shows no sign of reversal. Momentum traders are still avoiding this name.
But high negative sentiment and heavy betting against the company create an interesting volatility profile. The short interest.
Right. The short interest remains quite high, hovering between 14% and 17% of the float. This represents bets that management will fail to service the 12% debt and be forced into a highly dilutive emergency equity raise. However, this level of short concentration is also fuel.
Right, it's a coiled spring.
It is. If ChargePoint manages to deliver even one positive operating cash flow quarter, proving they can start to manage the debt noose, this short interest creates the structural potential for a very violent short squeeze, driving the price upward rapidly.
Chapter 5. Ownership structure.
Okay.
The people who bought this stock in the past are often not the people holding it today. Who still owns ChargePoint, and what are the major institutional holders signaling?
This is a classic fallen angel profile characterized by institutional capitulation. Major asset managers like BlackRock and Vanguard have been actively shrinking their exposure. BlackRock, as our sources show, cut its stake by almost 70% in recent reporting periods.
70%. A 70% cut from a major institution like BlackRock. How much does that lack of an institutional anchor magnify the stock's volatility on a day-to-day basis?
It's a huge factor in volatility and credibility. Institutional ownership is now low, sitting between 22% and 28%. Many large funds have investment mandates that force them to sell distressed assets, or they're required to liquidate stocks trading below specific dollar thresholds. This institutional exodus means the stock lacks large, stabilizing forces, making it more susceptible to panic selling and algorithmic trading swings.
Let's turn to the people who theoretically know the most, the insiders. We discussed the absence of open market purchases, but let's reinforce why that is such a devastating signal.
Insider ownership is minimal, roughly 2%. And while the sell-to-cover activity is routine for vested shares, the fact that no executive zero is deploying personal capital to purchase shares at this depressed price point is the most powerful negative signal to the market.
They are saying, I am happy to take free shares and immediately sell some to pay taxes, but I will not risk my own cash on this turnaround.
Exactly. They know the risk profile better than anyone, particularly the pressure of that 12% debt service. Their collective non-action speaks volumes. They do not see an immediate, clear path to undervaluation that outweighs the high probability of further operational hiccups or dilution.
So the overall ownership base, then, is incredibly fragmented. Why does lacking a strategic anchor investor matter so much for a company in this position?
Fragmentation among retail and algorithmic traders provides no stability. What ChargePoint desperately needs is a strategic, long-term anchor investor, for instance, a major utility like Consolidated Edison, or a large automotive OEM like Ford, taking a significant 15% to 20% stake.
Someone with deep pockets and a vested interest.
Exactly. That type of investor would provide immediate capital stability, guaranteed demand for their charging solutions, and invaluable industry expertise, drastically reducing the perceived risk profile. Without that anchor, they are completely exposed to market sentiment.
Chapter 6. Risk Assessment.
All right. We utilize the SWOT framework to synthesize the internal strengths they must leverage against the external existential threats that could wipe them out before they reach profitability.
Let's start with the strengths, the foundation that justifies the base case valuation of $6.50 to $9.
First, the dominant L2 network scale. Their installed base is the largest in commercial L2, a physical and data asset that's difficult to replicate. Second is software sophistication. Their fleet management and billing clearinghouse platform is genuinely best in class, offering complex services competitors struggle to match. And third is the sticky recurring revenue. That 40% high-margin subscription base provides a crucial floor to their revenue, acting as a lifeline if hardware sales completely collapse.
Okay, now for the weaknesses, the internal flaws that the new management team must urgently correct.
The primary weakness is the broken balance sheet. The $157 million senior secured debt at 12% interest is the #1 constraint. It starves R&D and expansion budgets. Second is the issue of perceived reliability. Because they rely on the site host model, drivers continuously blame the ChargePoint brand for broken chargers, severely damaging the ecosystem's trust compared to vertically integrated rivals.
They own the brand reputation without owning the maintenance quality.
Precisely. And third, the continued reliance on hardware drag, which is still cyclical, low margin, and cash intensive.
Moving to opportunities, if Wilmer pulls off this turnaround, what is the path to that bull case $14 to $18 valuation?
The first major opportunity is fleet electrification. Commercial, municipal, and last-mile logistics fleets are the next major wave of EV adoption. ChargePoint software is perfectly tailored for depot management, vehicle scheduling, and load balancing, making it a powerful high-growth vector. Second, the distressed valuation makes them a prime consolidation target.
A takeover target.
A prime one. A strategic buyer shell, BP, Amazon, or a major utility, could acquire ChargePoint for under $200 million, integrate the software, and use it as an instant platform for future energy services.
And the third opportunity, the one tied to the defensive strategy, the Eaton pivot.
The Eaton partnership is key to de-risking the hardware business. If ChargePoint can successfully leverage Eaton's expertise and capital to minimize its own manufacturing complexity, it can dramatically lower its COGS, stabilize hardware margins, and transition toward being valued purely for the high-margin network software, a pure SaaS multiple. That shift, if successful, unlocks immense value.
Finally, we must confront the threats, the external, existential risks entirely out of management's hands.
The most immediate threat is the Tesla and SES integration. The supercharger network opening to non-Tesla vehicles fundamentally diminishes the value proposition of ChargePoint's public L2 network. I mean, why wait 3 hours at an L2 charger when a reliable, fast L3 supercharger is now available nearby? The consumer utility curve is shifting dramatically away from CHPT's main historical strength.
And the high interest rate macro drag continues to stifle the capital expenditures of their customers.
Yes, the 10-year Treasury yield is an operational constraint for ChargePoint. It increases the borrowing cost for every customer looking to buy $100,000 worth of new chargers, causing a continuous pipeline slowdown. But let's look at the geopolitical risks. The 2025 tariffs are looming large.
How do those tariffs, specifically the 25% on steel and aluminum and Section 301 tariffs on Chinese components, directly impact ChargePoint?
They pose an immense threat because they directly inflate the cost of goods sold for hardware. Steel and aluminum are integral to rugged charger enclosures. If those costs jump 25% overnight due to geopolitical tariffs, it squeezes those already razor-thin hardware margins even further. This makes the path to operational break-even that much harder and accelerates the cash burn.
And the political risk associated with subsidies, particularly the Inflation Reduction Act, the IRA tax credits, is the nuclear option.
That is an existential threat. The potential repeal or severe restriction of the IRA tax credits by a future administration would instantly crush the return on investment, the ROI models for ChargePoint's commercial customers. If those tax credits are suddenly removed, a massive wave of infrastructure order cancellations would follow, potentially collapsing their revenue pipeline and guaranteeing a liquidity crisis.
The SWOT framework makes it clear. The strengths are sufficient to survive, but the threats and the crippling debt load are equally powerful forces pulling the company toward the bear case.
Chapter 7, Conclusion.
Yeah.
This is where we bring everything together and provide a final synthesis of this truly binary investment proposition.
Let's synthesize the bull case one final time.
Right.
What must happen and how quickly to justify the potential $14 to $18 upside?
The bull case requires flawless execution of the turnaround, led by CEO Wilmer. They must successfully stem the cash bleed through cost-cutting and accelerate the high-margin software transition. They must use the Eaton partnership to de-risk the hardware. If subscription revenue stabilizes at 50% or 60% of the mix, the operating cash flow will eventually be sufficient to service that painful 12% debt. If they can manage that debt noose for 2 years, they survive and re-rate as a specialized SaaS stock.
And the bear case? The path to $2.50 or, insolvency?
The bear case hinges on the liquidity trap. It argues that the 12% debt is too heavy a burden for a company with contracting revenue. Competition from Tesla accelerates, macro headwinds continue to stifle customer capex, and ChargePoint fails to reach FCF positivity before its limited cash reserves are depleted. The debt service drains the company's operating ability, forcing a highly dilutive distressed equity raise, or potentially leading to a fire sale acquisition at an even lower valuation.
So where does the current trading price, $7.89, stand in relation to the company's internal financial mechanics?
The current price is right in the middle of our base case intrinsic value range, $6.50 to $9 per share. The market has efficiently priced the stock as a distressed call option. It has discounted the massive historical growth premium and is paying for stabilization, not future expansion.
So given the intense risk and the high reward associated with this binary outcome, what is the final outlook?
We maintain the neutral hold outlook. This is strictly a survival play. It is no longer a growth stock. If you are holding or considering an investment, you must realize that you are betting entirely on management's ability to execute a perfect pivot in a hostile macroeconomic environment. The required catalyst for us to seriously reevaluate to a buy would be at least 2 consecutive quarters of stable or growing subscription revenue and critically confirmed positive operating cash flow. They need to prove they can manage the debt noose and fund themselves internally.
That brings us to a final provocative thought for you to consider. The company is desperately trying to reduce its reliance on low-margin hardware through partnerships. If they successfully execute this pivot and stabilize the balance sheet, should ChargePoint fully divest from manufacturing and selling hardware altogether?
Think about the implications. If they eliminate the low-margin hardware drag entirely, can they truly transform into a pure software network manager? Could they become the high-margin operating system of a grid, simply selling data, billing, and energy management services to every other company like Eaton or ABB that does build the physical box? That would be the cleanest, highest margin path to a true SaaS multiple.
That is the path to pure profitability, but it requires them to survive the next 2 years first. We hope this deep dive gave you the clarity needed on this highly volatile, high-risk stock. If you found this useful, please hit the like button and subscribe to Stock Analytics AI.
Remember, for $4.999 a month, you gain access to our extensive library of over 500-plus deep dive videos on all S&P 500 stocks, with the NASDAQ 100 coming next, plus members-only requested deep dives.
Subscribe now for more deep dives. We're happy to share our research with you.
This analysis was generated based on AI research source material for educational purposes only and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.